Hello everyone, another week packed full of crucial news in Argentina, with Milei making moves to get his reformist agenda going in Congress, where he now has the largest minority in the lower house and a very strong foothold in the Senate if we add La Libertad Avanza's allies to that tally. So let's get into it. First, Argentina returned to voluntary debt markets for the first time since 2018. The Treasury raised about $910 million, placing a local law dollar bond due in 2029 at a yield of 9.26%. That came roughly 100 basis points below where similar bonds were trading in the secondary market, a positive sign in terms of demand, even though it missed the government's sub 9% target. More than 2,500 predominantly domestic investors took part in the auction, but still country risk remains stubbornly above 600 basis points, underscoring how much work the Milei administration still has ahead of itself in order to improve Argentina's tarnished reputation in debt markets. Second, Milei also signed his first major labor reform bill. The government dropped plans to eliminate mandatory union fees to avoid a direct clash with labor groups, but kept measures aimed at reducing litigation, lowering hiring costs, and forcing long-expired labor contracts to be renegotiated. Argentine business leaders such as Paulo Roca of Techint largely welcomed the bill, while making it clear in some cases that tax reform is what should truly change investment decisions in Argentina. In other words, lowering taxes. I should mention, however, that the CGT umbrella union grouping is planning on marching on Plaza de Mayo in a protest against this bill on Thursday. Third, the government unveiled a hardline fiscal framework designed to outlast Milei's term. The proposal would punish unfunded spending and unauthorized money printing, tighten limits on provincial borrowing, and require fiscal impact reports for any bill that raises expenditure. Pension reform, however, was left for later, reflecting the view that labor informality must first be addressed. Fourth, Milei announced plans to visit the UK, something no Argentine president has done in more than 25 years. Milei himself told The Telegraph that the aim is to normalize relations, reopen access to defense procurement markets, and keep the Malvinas issue on a strictly diplomatic track. Number 5, the Argentine Treasury accelerated its dollar purchasing ahead of January debt payments. Combined with the dollar bond issuance that I mentioned earlier, the government is building up a buffer without tapping central bank reserves to pay for those debt maturities coming up in January. At the same time, official data shows that dollar demand among Argentines has collapsed after the midterm elections, easing pressure on the FX market. 6. The government is weighing an expansion of tax incentives under the RIGI scheme for shale oil projects at Vaca Muerta. Meanwhile, major fertilizer producer Profertil has changed hands, with Tether-owned Adecoagro, listed on the New York Stock Exchange, signing its takeover from YPF this week. We're talking here about a roughly $1 billion deal. And finally, 7, inflation ticked higher again in November, a reminder that disinflation won't be linear even as price growth remains far below last year's levels. Taken together, this week shows Milei's strategy in motion, imposing fiscal rules, regaining market access, pushing structural reforms, and managing the political sphere just enough to keep momentum going. So that's it from me this week in the Argentina brief. I'll see you next Sunday, and as always, I greatly appreciate all likes and retweets. Have a great week.